We are in the midst of extreme levels of market volatility. With the rapid pace of rising interest rates, inflation exceeding central bank targets, record low unemployment levels which in turn is pushing wages higher, which as a result keeps inflation at stubbornly high levels. What does all of this mean for us as investors? Before the COVID-19 pandemic, for the past 10 to 12 years we have had it relatively easy when it comes to the financial markets. In the last 10 years, the earnings of the S&P 500 companies has roughly doubled and the unit price has tripled, during which the highest federal funds was just 2.5%. So, this begs the question. Is now a good time for investors and businesses to expand, valuations to grow and investors to make money? At the end of 2019, it seemed like anything bought invested in was doubling fast at a rapid rate, however now we're less certain. But then the pandemic hit. Businesses shut, volatility ensued, some companies ceased operations, unemployment looked uncertain, as did economic forecasts. Now inflation is at a 40-year high, the interest rates are rising sharply which restrict businesses and investors in accessing money, thus putting the brakes on the economy. This resulted in cryptocurrencies being wiped out, property prices declining, blue-chip companies struggling, and the stock markets looking quite shaky, spooking investors across the globe. But despite all the chaos and volatility in the market, now more than ever could be one of the greatest opportunities we have seen in the past decade to get ahead and build your wealth. So, let's talk about why now is a good opportunity to invest and to use it to your advantage.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all.
No, I mean, what are dumb things? Selling a stock because it goes down?
Yeah, selling a stock because it goes down.
Psychology has a great deal to do with successful investing. The simple idea of investing is buying low and selling high, but in reality most people do the exact opposite. They buy high and sell low. They don't mean to do this, but when times get tough, the fear, uncertainty and doubt scares investors out of the market. But as Warren Buffett says, when the market is down heavily, when fear is high, and media headlines are as negative as can be, that is the best time to invest. The lower the entry point, the better.
Anytime stocks go down, as far as I'm concerned, I like it because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news in terms of anything I buy.
The reason for an investor to think about buying high is that they do not have clear investing goals and have not committed themselves to a long-term investing time horizon. So, when the timing is bad and the recession hits, instead of seizing this opportunity, they run away from the possibility of short-term pain. Here is a history of the US bull and bear market since 1926. The bulls are in blue, the bears are in orange and the recessions are the light orange bars. In that time since 1926, there were 15 recessions and 11 bear markets. The bear market lasted for 14.7 years, and alongside that there were 75.4 years where the market was in a bull run. As it shows, if you can hold through and go against the grain and invest during these periods, you are often very well rewarded. There are two types of investing style for long-term investing. The first is dollar cost averaging. For those that do not know what dollar cost averaging is, it is very simply taking your money and investing a set portion of it on a regular basis over a period of time, into something such as a low-cost index fund, or managed fund. This passive investing method is designed to take the emotion out of investing and reduce the volatility, but still give you rewards of positive long-term returns and achieving your financial goals. Besides passive investing, some investors like having a greater control of their portfolios and opt for the approach of buying individual companies they have strong beliefs in and see as opportunities to deliver positive returns for their portfolios. Overall, this is why recessions are a great opportunity for astute investors. The greatest takeaway is to keep on keeping on, stay strong and go long. To leverage this opportunity, contact a financial advisor at GFC to help plan your portfolio today, ensure it's aligned to your financial goals, and that you don't miss what could be one of the greatest investment opportunities we have seen in years.